If we were to compare the state of the climate funding landscape between 2025 and 6, the best adjective would be testing. Entrepreneurs and SMBs are finding themselves dealing with tightening federal policy support for climate businesses. Now, just to give some context, in the first half of 2025, nearly $22 billion in clean energy projects was canceled and more than 11,000 jobs annulled. And in 2026, proposed spending cuts of billions of dollars in clean energy projects are being put forward, which of course is facing opposition. And moreover, with the rescinding of IRA incentives, as well as the withdrawal of major banks from the Net Zero Banking Alliance, companies are finding themselves increasingly walking on a tightrope. In today's episode, we're going to be shedding light on how non-dilutive funding sources can serve to bridge this gap and sort of serve as a popular as well as viable alternative in today's landscape. We're also going to be shedding light on how companies such as Enduring Planet are playing the essential role of, fulfilling that gaping middle and striving to make financing more accessible. To speak more on the matter, I'd like to warmly welcome Dimitry Gershenson. He is a co-founder at Enduring Planet, a financial advisory firm that provides FP&A support and lending services to SMBs and startups. Dimitry, thank you for joining us today. Could you give us a brief introduction of yourself and also explain to us how Enduring Planet came into being? Over to you.
Yeah, so thanks so much for having me, Nita. So maybe I'll just reintroduce the firm and then talk a little bit about my background. So Enduring Planet does two primary things in the climate ecosystem. We are a lender, so we provide debt financing to climate companies, and we also provide what we call sort of fractional financial services or FinOps to climate startups and SMBs. So not only do we support their liquidity and capitalization needs, but we also help them manage their finances in order to be more resilient in times of change and raise capital from other sources and in general, do the work that's needed to address the climate crisis. I've been working in climate for, over 15 years now and on climate finance topics for over a decade. And we, initially started Enduring Planet as purely a lending business to meet this sort of early stage credit gap that we had identified in the space. But over time, we realized that a lot of the companies we were seeing, their internal operations were so messy that they couldn't raise capital. And that to us felt like a real miss, especially when those businesses were performing really well. And so that's why we launched the fractional CFO business 2 years ago. And now we serve nearly 100 companies with that work stream. And on the lending side, we've done over 100 transactions with about 80 borrowers, about $40 million deployed.
Right. Thank you for the introduction. And I think it's only when you start stepping in do you realize what kind of, knots that you have to untangle when we talk about FP&A support. So I totally get you when you say when the FinOps, you have to make it look and act, function perfectly and efficiently so that they can actually achieve what they've set up, essentially. So yeah, I'm going to move on to my next question, which is now going to start, going deeper into non-dilutive funding. So if we were to look at the evolution of non-dilutive funding, we can see in the US, particularly speaking, there's been a noticeable shift from equity dominance to diversification, where debt and grants are increasingly occupying an expanding share of the total pie. So based on your observations, how are founders dealing with this new reality and what's actually happening on ground?
Yeah, I think there's a lot of talk about what's happening, and then there's reality, and they're not always aligned. So one is, I think there's a lot of commentary on the loss of public grants in climate in the US, which is, I think, mostly sensationalist. There's actually still quite a bit of even federal grant funding for climate companies, lots of state and city funding for climate companies. And in fact, the federal government recently rolled back a lot of the cancellations that they made at the start of the Trump administration, and are now resuming paying a lot of those grantees. Obviously, a significant chunk of money has been lost, but it's not a total collapse. So I think that's important. Two is that the equity pullback in climate is in part driven by that, but it's also driven by the big like push into AI. And so the kind of challenging equity environment is not just a product of a change in sort of political or social attitudes. It's also a product of the fact that VCs chase hype and the hype has shifted, right? And so what that has done is it means that now there are financing gaps for these companies that didn't exist before in the same way. And so founders are forced to look at how they adjust their sort of capital formation to meet the moment. And, I would argue that they probably should have been raising debt the entire time because debt is cheaper than equity. You lose less control. And for a lot of applications, people were raising equity when they should have been financing that specific work with debt. And the typical guidance that I give founders is if you are trying to fund a very predictable outcome, let's say you have a grant that's reimbursement based with no performance risk, you should not raise equity to pay for the work to do that grant so that you can then get reimbursed by the government. That's not an effective capitalization model. And so now that equity is less plenty and arguably much more expensive because also pricing has been compressed quite dramatically in the market if you're not an AI, people are now starting to realize that debt is a very effective option. And so lots and lots of companies are looking for credit to finance predictable outcomes, large contracts with government, large contracts with corporates, predictable revenue streams, et cetera. And it's honestly, it's probably better for the long-term viability of the market for it to be more capital efficient.
Yeah, so it's a good point you raised about how there's a lot of sensation about because wherever you read online, there's just all you read is about the government rolling back those incentives, and that's exactly how I started off. And it's I think it's very important to educate. And at the same time, I feel that companies such as Enduring Planet, sorry, and others in the space are doing a very essential role in educating entrepreneurs as well as SMBs, providing that financial literacy of the importance of debt and that equity should not be the first option to go. Yeah.
Well,
So
I think
now,
it's less about
moving
what I
on to
think
my.
it's. Wait, hold on, Nina. I think it's less about what's first or second and more about how you align capital to the use case. And I think a lot of entrepreneurs are told early that, capital is stage specific. Like, oh, you're an early stage company, you can only get equity, or you're a late stage company, you should finance things with debt. And that's like really bad guidance. In reality, it's about aligning your inputs with your outputs.
Okay, yeah, makes sense. So my next question sort of draws on these lines. It's all about understanding from the point of view of the investor, understanding your investee better. So when it comes to financing asset-intensive climate tech ventures such as green steel or even EV fleets, conventional financing sources such as banks or even VCs may not be appropriate. So based on your experiences, could you help us explain why these traditional financing sources may not fully appreciate the business model of such ventures?
I would be careful to paint it with a broad brush, right? Like in a lot of cases, the companies we finance raise equity, they raise grants, and they raise debt. I think what often happens is that, or has happened in the market to date, is that a lot of companies were formed in the early 2020s. At that time, venture capital was very, very like frothy. There was like so much money, very high valuations. Everybody was able to raise capital, despite the fact that they might not have a truly venture backable business. And the definition of what's venture backable changes based on the vibes in the economy, right? And so the goalposts have fundamentally shifted between then and now. And a lot of companies that raised early equity through that model are now going back to market and are unable to raise the financing despite having significant traction and performance. And the thing is that when you are a lender, you're not evaluating an opportunity based on its competitive advantages or long-term success or possible exit. All you're doing is evaluating whether or not repayment can happen on the timeline that you want. And so it's like fundamentally different analysis. I think when it comes to banks in climate, there are pretty significant limitations of what a bank can or cannot do given regulatory frameworks. And so a lot of the things that are being financed by private credit are just not financeable by banks. And then I think the last thing that's worth mentioning is that a lot of the private credit that is available in the climate ecosystem is typically focused on larger ticket sizes, given the transaction costs associated with doing those deals. And the legal costs, the structuring costs, they're more complicated transactions. So there's a pretty material gap in the space, basically up to kind of the $10 million mark. Very little credit available. And that's the place where we play today. And so I think the savviest founders are getting better at understanding what options are available to them, when they're appropriate, when to pursue them, how to present yourself so that you are then palatable to those types of investors. And the folks that are being really successful now are really good at that part of the process. It's not like rocket surgery, but it is still complicated. And a lot of founders don't invest the right amount of time in understanding the financial landscape so that they can be capital efficient.
Right. So, if I were to sum it up the best I could, I think during the time of COVID, there was this VC frenzy, and they're just pouring money literally into startups, and that kind of sort of changed when things started tightening up and inflation hit the roof, and then money wasn't so easy to come by, and then and then I think that conservatism started creeping in and all that. So so it's important to understand how your investor is looking at you from a founder's perspective, because at the end of the day, investors are looking to cover up the costs as well as the risks of their investment. So accordingly, the price or the premium that they charge will depend on that. And founders who understand that early on are more successful at raising financing. It's all about investor readiness. You could put it that way.
Yeah.
Right. So I now, I'm going to lead my discussion to how Enduring Planet designs and deploys creative lending structures to introduce flexibility for borrowers. Your partnership with the Best Bees Company is worth mentioning in this context. I'd like you to explain to the audience how Enduring Planet's inclusive approach makes funding more accessible for this nature of it.
Yeah, I mean, I think there are a few kind of key elements to how we approach the market that are somewhat unique. One is that we have a very streamlined application and underwriting process where we try to limit the amount of time that we take from borrowers. Now, sometimes people apply for funding, they have messy financials, they have complicated contracts. In those cases, we still have to do our homework, but we still try to do our best to reduce the overall effort required by the entrepreneur to apply for financing. One of the ways that we do that is we connect to people's financials live. So they don't have to give us self-submitted, bank statements. We don't have to then validate that data in other ways because it's self-submitted. Like we get raw financial data from banking and accounting systems, which gives us a lot more comfort with what we're reviewing. Another thing that we do is we have standard legal agreements. So we generally don't negotiate legal. The agreement is what you get. This allows us to dramatically reduce the legal costs associated with doing a transaction like this. And our structures are very simple. So generally, there's not a lot of debate, right? It doesn't even really get introduced because folks are generally comfortable with what we propose. Another thing that we do is we don't require personal guarantees. We found that personal guarantees are a significant barrier, especially for underrepresented founders, folks coming from low income backgrounds. It's like almost like a wealth and class filter that we don't really appreciate, and we don't think it adds material benefit to the risk mitigation of a loan. We also, for a lot of our transactions, what we do is we align repayment with inflows from the contracts that we're underwriting. So rather than having a flat amortization where companies pay us regardless of how the contract is doing, they pay us when the contract pays them. And so that reduces the sort of cash flow burden of loan servicing in a way that we feel better aligns those interests. I think those are kind of the primary components. But also maybe last, like worth mentioning is that when things do go wrong, we're generally very, very friendly and amenable to uh, changing and modifying our loans to align with the company's needs, as long as the company is engaging in good faith and communicating really well with us. And we have lots of examples where folks needed an extra 2 to 3 months. We didn't penalize them at all. We just kept the loan moving, and everybody made out okay at the end, rather than like forcing a company into default, forcing a company to navigate a breach. We find that generally that presents more problems than it solves.
And I think, I mean, lastly, this goes to show that when the investor demonstrates some patience, then, the roof then necessarily doesn't have to fall on your head,
Yep.
I mean, and especially in this space, when things are just so difficult and it seems so, especially when you are looking at underrepresented and low income founders, it only helps to expand the cause and make everything more accessible. And what I especially find not really useful. I mean, useful is a not the most perfect word to use, but the most helpful. I mean, if you compare it to bank financing, the ability to align your payments when you pay when the cash flows come in, I think that really eases the pressure off the founder's shoulders, that that you're not you don't have to pay back immediately. So yeah.
Yeah, agreed.
So now my next question now heads over to the future. Um, Looking ahead, what's your outlook on the potential for non-dilutive financing to scale growth for climate ventures in general?
I mean, I think the potential is immense, right? So the need for capital in the market is great, right? That, I mean, really, that's an understatement. It's like many, many trillions of dollars a year that are still necessary for us to hit any of the like climate targets that we as a global community have tried to rally around. I expect non-dilutive capital, grants and debt to be, historically, I think that funding has generally been somewhere in the like, call it 20% of the total mix of capital in the market. If you include incentives and grants and kind of all the sources of what we would call non-dilutive capital. And as the market matures and grows, as there's more and more companies coming into the ecosystem to solve distinct problems, the need for that capital is only going to grow. And so we're doubling down. Like we're not going anywhere, but we're really excited about the growth in the market and the maturity in the market. And while equity can be finicky and vibes driven, like that's not how credit works.
Yeah, credit is more patient, I'd like to say, especially the enduring planet credit kind of credit. For joining us today and sharing your experience and wisdom with the audience. To my audience, I look forward to seeing you in the next episode of Sustainability Shorts. Thank you for listening in, and please leave your feedback after you watch the video.
Thank you, Nita.